Welcome to all of our High Rock clients and any other listeners who have joined us this week, and thanks for taking the time to tune in to our weekly webinar where we're going to talk about what we see happening in the global economy and financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and financial planner, Bianca Tomlinson, this week. Paul Tepsich, the founder of High Rock, is in Colorado this week with his young son, Nicholas, who is competing in the North American Snowboard Racing Championships. So good luck, Nicholas. We will have a question and answer period at the end of the call if I don't run too far over my scheduled time, which I have been doing the last couple of weeks. Apologies for that. But at that time, if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that we will provide you with this on our website under the About High Rock tab. Well, let's quickly recap our themes for 2016 before we get started on what happened last week. Our overriding theme for 2016 is that financial markets will remain volatile. January saw a big spike in volatility, but markets settled in late February and March, thanks to continued monetary stimulus by central banks around the world. Volatility has slipped back to the low levels of last October, although we saw a bit of an uptick today, an eerie calm before the storm, perhaps. Well, the big question remains whether or not the U.S. economy will continue to be able to grow while less positive global economic forces provide a drag. The consumer is not, at the moment, providing a significant lift to the domestic economy, despite improving employment growth, and there are other historically important indicators that have preceded recessions in the past that are starting to show some disturbing trends. More on that a little later in the call. Well, commodity prices, and especially oil, are testing their recent uptrends. Core inflation in North America has picked up a bit, but not so much in other parts of the global economy, leaving inflation-guided central banks in a bit of a quandary. The European Central Bank increased its monetary stimulus. The Bank of Japan and People's Bank of China have done so as well. The Bank of Canada is on hold until they're able to analyze the impact of the latest Canadian budget, but the Canadian dollar's recent strength may have them concerned. The U.S. Federal Reserve has pulled back from tightening for now, and the Bank of England also remains on hold. Geopolitical wildcards like the UK leaving the European Union, the Donald Trump factor, OPEC and oil-producing nations, China, North Korea, terrorist activity, and the refugee crisis are all increasing the levels of uncertainty. We do continue to watch bond markets for clues, but with some central banks forcing negative interest rates, that picture may be a little bit distorted. Equity markets remain expensive, although a little less so than this time last May, or I should say last May. Earnings growth has declined over the last 3 quarters and will probably decline in the first 2 quarters of 2016, and estimates for all of 2016 continue to be revised lower. We remain in a time of lower than average returns when after 6 years of above average returns, and as the cycle evolves, longer term returns are moving back toward the average. Well, plenty has happened since our last webinar. Right now, however, some of us are stuck in a frigid polar vortex just when we thought spring weather might be arriving. But let's get to the financial markets because there is plenty going on there as well. In keeping with our key theme for 2016, it was a wild ride in January and the early part of February. But volatility eased up as the People's Bank of China, the Bank of Japan, and the European Central Bank all added further monetary stimulus, and the U.S. Federal Reserve lowered expectations for higher rates. Now we are in a wait-and-see pattern. The recent uptick over the last few days may be signaling the end of the calm. But volatility remains below its long-term average. CNN Money's Fear and Greed Index hit a low near 9 in January. Now it has moved back into greed territory. In fact, last week and the week before, it was up into the extreme greed territory. So we've slipped a little, but stimulative central banks have really forced money out of lower yielding safe assets and into riskier assets. Markets have moved rather quickly from oversold to overbought. We suspect that the next move will likely take us lower. Well, since our last webinar, our benchmark world equity index is down by 1.5% and is now lower on the year. Last week it was slightly positive on the year. Shanghai's China Composite Index was the best performer since last Tuesday. Japan's Nikkei 225 was the worst performer. Now our strategy for 2016 to be overweight the Canadian equity market and underweight the U.S. equity market for rebalancing purposes continues to work favorably. On a total return basis, which includes dividends and currency fluctuations, the TSX is up by 3.75%, while the S&P 500 in Canadian dollar terms is lower by 3.5%, which is a net difference of positive 7.5% in our favor. Now, the TSX has been the best performing country index in the developed world this year. Now, the Canadian REIT index has also done very well. We have an allocation to that asset class in our global equity model. Well, after hitting highs last May near 63, our benchmark world equity index made new lows near 49 in mid-January, and then again in early February, which was a 22% drop from the highs. Now then it found buying support from short covering and a little value investing after such a large decline. Well, last week, after the markets had been moving higher, the top of the channel was tested with some buying, but it failed to break through, and subsequent selling has pushed prices lower again. Now, the downtrend channel remains intact as we continue to see lower lows and lower highs. And until this pattern and the downtrend is broken, we should be on guard for further selling pressure, especially as markets still are close to overbought territory. Now, the next test could well be to see where buying support might materialize, and this could possibly take us all the way to test the bottom of the channel. Also notice that trading volume continues to remain low at the higher prices. Without volume follow-through, this move has, for the moment, run out of momentum to the upside. Now, until we see positive developments and a change in the trend, we will be sticking to our overweight cash thesis in our equity models. Another positive week for quality fixed income as government bonds outperformed riskier bonds and preferred shares. The U.S.-Canada 10-year yield spreads narrowed this week as Fed Chairwoman Janet Yellen took a softer tone on future rate increases. Oil was the worst performer on the commodities front since last Tuesday. Oil found selling pressure in the low 40s and will need to find buying support above the $30 mark to continue its breakout of the downtrend channel. We'll watch carefully as developments materialize there. The Bloomberg Commodity Index has turned lower, breaking support of the bottom of the new uptrend channel. Now, that's not a good sign for the global economy if this does continue. And the Canadian dollar, after closely tracking oil prices as they fell, dislocated itself from that pattern when the Bank of Canada held rates steady and the Canadian government opted for larger deficit spending to boost the Canadian economy. However, weaker export data has traders wondering about whether a rate cut with oil prices, has traders wondering about another rate cut. And with oil prices falling, the Canadian dollar is feeling some pressure. We were selling Canadian dollars and buying US dollars for our models last week, not far from the highs. This is to utilize for future US bond purchases and perhaps other US assets that we want to purchase in our models. Well, our benchmark world equity index is comprised of about 52% of US companies, so we keep a close eye on what is happening in the US economy. The Federal Open Market Committee believes that the economy has been expanding at a moderate pace, and I underline has been because that is now historical information. They expect this to continue with a big however where global economic and financial developments continue to pose risks. And as per usual, interest rates will depend on incoming data. Last week in a speech, Fed Chair Yellen took a more dovish tone as global economic concerns seem to be overshadowing the positive employment data. Tomorrow we will see the minutes from the most recent Federal Reserve meeting, the FOMC meeting, and that should shed further light onto the sentiment amongst the committee members. Well, in December, the FOMC members anticipated an average of 4 interest rate increases, which would have indicated about a full percentage point for 2016, which would have taken the federal funds rate to approximately 1.5%. As we suspected, they have modified this as economic conditions remain under pressure. It now appears likely to them that there might only be 2 increases for all of this year. We might suggest that this is rather optimistic in and of itself. Well, the Fed's mandate is to foster maximum employment and price stability. Inflation has started to move a little bit higher, but remains below the Fed's target at the moment. Employment growth continues to add hope for the domestic economy. But despite improving labor conditions, consumer confidence has not been growing, and consumers have not necessarily followed through with spending as retail sales have not kept up. The consumer contributes approximately 2/3 to the economy in the United States. Manufacturing data has improved with the latest data, but the GDP Now model forecast for real GDP growth in the first quarter of 2016 is at only 0.4%. After yesterday morning's light vehicle sales release from the U.S. Bureau of Economic Analysis and the manufacturing report from the U.S. Bureau of the Census, the forecast for real GDP growth declined. And this is based on declines in the forecast for real consumer spending growth and real equipment investment growth. Remember I said the consumer is an enormous part of the U.S. economy. Now the forecast for real GDP growth remained at 0.4% after this morning's international trade report from the U.S. Census Bureau, as a slight decline in the forecast for real net exports was offset by a slight increase in the forecast of real equipment investment growth. This is not what we would call positive economic news. The consensus expectations for U.S. economic growth are closer to 2%. And it is expected that the U.S. economy will contribute over 20% of the global economic growth. And one of our themes for 2016 asks, will it be able to accomplish that? Well, we've discussed the relationship between high inventory to sales ratios and recessions in previous calls. As inventories rise and sales fall, companies have to reduce production and prices and earnings fall until costs are cut. We will see the latest data on wholesale inventory and wholesale sales coming this Friday, so we'll be watching that very closely. A couple of weeks ago, we introduced another indicator of past recessions, the relationship between the ratio of coincident indicators to lagging indicators. Now, historically, this indicator has fallen in advance of a recession. It is and has been falling rather recently. When coincident economic indicators fall faster than lagging indicators, it is a sign that the economic cycle is running out of steam. And historically, corporate profits have turned lower preceding a recession. Corporate earnings growth has been declining in the previous 3 quarters and is now expected to fall in the first 2 quarters of 2016. These three indicators leave us more than a little concerned about the current state of the U.S. economy. So let's have a look at what is happening in the global economy. In general, there was an eerie calm that had settled over financial markets as we waited to see the next round of economic data. After all, the monetary stimulus from the European Central Bank, the Bank of Japan, and the People's Bank of China. Early results are looking grim for the Eurozone and Japan, but slightly better for China, although it may take a little more time to get a better reading on all of what comes next. Euro area companies represent about 16% of the world equity index. Back in March, Mario Draghi surprised financial markets with a number of new monetary policy measures intended to assist economic growth and spur inflation. Financial markets are now waiting to see if any economic indicators can show signs of improvement. Core inflation in March inched ever so slightly higher, but still remains well below target. Japanese companies represent 8% of the world equity index. In February, the Bank of Japan surprised financial markets with their first step into negative interest rates. At March's meeting, there was no change to monetary policy. The Bank of Japan is hopeful that these measures will stir the Japanese economy. Financial markets are waiting to see what results come from that. So far, from a look at Japanese manufacturing, it has slipped into contraction territory with the most recent data. So not good signs in the early going subsequent to all that Japanese monetary stimulus. Well, UK companies represent 7% of the global equity index. At March's meeting, the Bank of England Monetary Policy voted unanimously to maintain the bank rate at 0.5%. Policymakers said inflation remains weak and noted that the uncertainty surrounding the referendum on UK membership of the European Union may delay spending decisions and depress growth. UK manufacturing, the latest round of data, shows us that it remains subdued. Britons will vote on June the 23rd whether or not to remain in the European Union. There are potentially significant economic implications for the UK as their participation in the European Union is in question. The Bank of England's Monetary Policy Committee issued a statement last week saying that risks associated with domestic credit are no longer subdued and global risks, which can also affect UK exposures indirectly, are heightened. The June 23rd referendum on the UK's membership of the European Union is the source of the most significant near-term domestic risks to financial stability. The latest polls from April 1 are showing that those who wish to remain in the Union hold an even slimmer advantage. Well, uncertainty has pushed the pound lower, although it is off its lows that it reached early in March. Chinese companies represent 2.5% of the world equity index. Back at the end of February, in an aggressively stimulative move, the People's Bank of China lowered the amount of deposits banks must hold in reserve. Chinese manufacturing showed a little bit of a sign of life in the latest data that was released last week. In Canada, where companies represent 3% of the world index, Canada's GDP in January grew at a faster pace than expected. However, the February trade data looked rather grim. Today's release showed exports declined by 5.4%, which is the worst level since May of 2009. The decline was led by energy and consumer goods. Imports also declined. This will concern the Bank of Canada and may put rate cuts back on the table as the Canadian dollar has been outperforming recently, and this is not helpful for exports. What do we see coming in on the horizon? Let's look at the bond markets because that's where we look for some clues. Each week we look at these government yield curves to assess what the bond market might be telling us. A positive sloping yield curve such as we see in the US, UK, and Canada could give us some hope of better economic conditions in time as investors want to receive greater returns to protect themselves against future inflation. Negative yields below the red zero line indicate fear of deflation in the short term, where investors want the safety of government bonds for protection from deflation. U.S. and German curves have flattened this week as economic prospects are pointing to lower inflation. If we look at the history of U.S. interest rates, the times when the 2-year in yellow, 10-year in green, and 30-year in purple yields are the widest apart, reflects the most positive sloping yield curve. When the Fed raises rates, the 2-year yield rises much more quickly than the 10 and 30-year yields, which flattens the yield curve considerably, and typically a recessionary period ensues. At the moment, the spreads between the three maturities remain relatively wide, but you can see why we focus on the U.S. Federal Reserve so closely, because usually when they start to tighten policy and raise interest rates, a recession is not too far away. With all the other indicators pointing in that direction, they will have to be very careful if they do not want to trigger another recession. Historically, high-yield bond markets lead equity markets, while the current gap remains to be closed and makes equity markets still look relatively expensive. The gap has narrowed as record inflows into high yield have narrowed the spread to equities. Canadian high yield continues to lag U.S. high yield in the most recent rally. Well, a few weeks ago, Paul talked about the potential of increased defaults in the energy sector to impact the financial system in the longer term. We are watching developments here quite closely. Oil prices will certainly have an impact here. Well, as for the equity markets and our strategy, when investors buy stocks, they buy a stream of future earnings. The price to earnings ratio represents a metric to measure stock prices relative to earnings. The 10-year average price to earnings ratio is 14.2 times. The 12-month forward price to earnings ratio is currently at an expensive 16.6. Last week, it was at 16.4. At the equity market highs back in May, it was at 17.1. As a result of downward revisions to earnings estimates, the estimated year-over-year earnings decline for the first quarter of 2016 is negative 8.5%, which is below the expected earnings growth of 0.3% back on December the 31st. It would be the fourth consecutive quarter of negative earnings growth. For all of 2016, analysts are projecting earnings increases of 2.2%. At the beginning of the year, analysts had projected 2016 earnings growth of 7.4%. So when that green dotted line, the S&P 500 prices, reaches the blue line, S&P 500 earnings, we can become somewhat more comfortable buying S&P 500 companies. Until then, we remain on the sidelines. Corporate profitability, the white line, tends to lead the S&P 500 with a lagged effect. We see no reason for it being different this time. In fact, it looks like an elastic band that's been stretched too far. The recent rally in stocks has pushed the enterprise value to earnings ratio higher, back towards 13 times and well above the longer-term average near 10.5. This prompted us to take some sales to further lighten our exposure to expensive U.S. equities. We've maintained for almost a year now that stocks were expensive on the many different metrics that we monitor. And as we have shown you for the last number of weeks, it has been corporations buying their own shares back. This graph really tells that story. The white line shows the amount of corporate buybacks which are reaching 2007 levels. Instead of paying out dividends or investing in capital expenditures for future growth, corporations have been buying back their own shares and driving share prices higher. Now, this becomes self-serving to a degree, as chief executives are often compensated on their company's share price. Retail investor buying of mutual funds peaked in the final quarter of 2014, as shown by the bar graph of money flowing in and out of mutual funds. 2015 and the beginning of this year show significant outflows. And it appears that corporate buybacks may be distorting the picture as stock prices remain lofty despite a low level of positive investor sentiment. When investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year. The most recent data show the trend to be continuing and certainly makes us very cautious. When the spread between large cap markets like the S&P 500 widens over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. When markets fell, that gap narrowed considerably, but the gap has widened as large cap markets have rallied more while the broader Russell 2000 have lagged. This also adds caution. So what does it all mean? Well, as I mentioned the word caution umpteen times, you know we're still playing defense. Last May, we decided that we would take a more cautious approach and a more defensive posture to investing, and in light of that, our key theme for 2016, that remains unchanged at the moment. We picked away at some value opportunities when they arise, but remain overweight cash until we see significantly better value in general. Central bankers and most economic forecasters are uncertain of the path of the global economy. We certainly are in that camp, and as Paul suggested in a Globe and Mail article a number of weeks ago, we are somewhat worried about the prospect of deflation and its potential effect on capital markets. Our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. It is easy to be and stay fully invested at all times. That is why most advisors might recommend sitting tight on a fully invested strategy. In many cases, as non-discretionary advisors are required to do, it is significantly more difficult and time-consuming for those advisors to adjust assets and positions one household at a time. That is why we use discretionary management, so that we can move all of our clients at the same time. We can be quicker, more efficient, and more impactful. Cash and cash equivalents have been and continue to be important defensive assets. So we are carrying greater than normal cash balances in our models. With equity market values having fallen so rapidly to begin 2016, we were able to find some opportunities to add reasonably cheap assets to client portfolios. This does not change our defensive strategy. We are being patient and only adding small percentage weightings at a time, leaving lots of ammunition for future equity market weakness and assets with better value if and when we should get it. Now, if we don't, we can and will adjust our strategy accordingly and quickly. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at High Rock will dictate the minor adjustments in short-term strategies that we make in our models, which we believe add value to the long-term performance, and that is how we can justify our fees. Our High Rock models are built to incorporate the need for diversity and balance with fixed income, global equity, and tactical mid and small cap companies. Because our key theme for 2016 is focused on greater levels of volatility, the cash or cash equivalent component in a client account, the underweight exposure to equity markets, and the overweight exposure to safe government bond markets helps to mitigate the impact of volatility on our portfolios. Now, our tactical model has taken advantage of some value purchases so far this year, like buying Rona before it was taken over by Lowe's at a 100% price increase, and picking up cheap shares in Paramount Energy before it tripled in price and we sold it. This is how we can add value to our and our client portfolios and help to get growth at the best risk-adjusted returns that we see possible. Well, on an administrative note, it is the end of the first quarter of 2016. Quarterly reports will follow shortly. Now, as is our policy, it is important to us to be able to sit down with you at least 2 times per year to have a detailed discussion of your current financial situation and determine if we need to make any portfolio strategy adjustments. If there are any major changes in your circumstances, or if you have any questions or concerns you need to discuss, we are always available. Okay, so what's up for next week? Well, tomorrow, as I said, we will see the minutes from the March Federal Open Market Committee meeting of the Federal Reserve, and that should give us a few hints as to their thinking. Thursday is a quiet day, busy on Friday with the Canadian Labor Force Survey for March. In Japan, we'll see the latest consumer confidence data for March. In the UK, we'll see the March industrial production, as I said, that key February wholesale inventories to sales ratio out of the US. On Sunday, we'll get a look at the March inflation in China, and then on Tuesday, we'll see the UK's inflation report. And of course, Tuesday is HIROC webinar day, so please remember to mark that in your calendars. Well, that is it for today's discussion. If anyone who is listening might have a question, I have 1 minute basically before I'm over my time, so go crazy. Okay, well, my time's up, so if you do have questions and wish to email us, we would be thrilled for you to send them. We also love to get feedback on these webinars, what you think is good, what is not, what else you might like to see us cover on these calls. As always, thank you for taking the time to tune in. Have an excellent rest of the week and a great weekend. And for those of you who enjoy it, enjoy the Masters. And especially for those who are sitting in the middle of the polar vortex, just have a quick peek there at the Masters golf course, and it'll give you a little bit of a warm feeling. Anyway, don't forget to tune in next Tuesday. And until then, this is Scott Thompson signing off.